You are sick. Not seriously. Not yet. A pain that has been there for 3 weeks that you have been ignoring because ignoring it was free and addressing it is not. You pull out your insurance card. You have insurance. You have had it for 2 years through your employer, and you have used it once for a physical that was supposed to be free and generated a bill for $140 that you are still not sure you should have paid. You call the number on the back of the card. What happens next has almost nothing to do with your health. It has everything to do with your balance sheet. Level 1. You have no insurance. You do not call anyone. There is no card to pull out. You have done the math on this before, probably more than once. The cheapest plan available to you on the exchange costs $310 a month. Your take-home pay is $2,100 a month. Rent is $950. Utilities, groceries, transportation. The $310 does not fit inside the number that is left over, and even if it did, the deductible on that plan is $6,500, which means the insurance would not actually pay for anything until you had already spent $6,500 out of pocket, which you do not have. So you make the calculation that millions of people make quietly every year. You go without. When something happens, and something eventually happens, you go to the emergency room because the emergency room cannot turn you away. The visit costs $2,800. You receive a bill. You cannot pay the bill. The hospital offers a payment plan. You pay $40 a month until you stop paying $40 a month because something else happens and the $40 has to go somewhere else. The bill goes to collections. Your credit score drops. The debt sits there accruing, a number attached to your name that follows you into every future financial decision you try to make. This is not a failure of personal responsibility. This is the arithmetic of a system where the cost of access is set above what access is worth to the people who need it most. The insurance exists. The price of the insurance is the barrier. You are not uninsured because you chose risk. You are uninsured because the alternative required money you did not have, to protect against costs you could not afford, through a deductible you could never reach without financial catastrophe. The system processed your situation and returned a result. The result was nothing. Level 2. You have the minimum. You are on Medicaid, or you found the lowest tier plan on the exchange, the one with the blue header and the $0 premium, because your income qualified you for full subsidies. The coverage exists. What it covers is the question. Your primary care physician, if you can find one who accepts your plan, has a patient panel of 2,500 people. The next available appointment is in 6 weeks. You need a referral to see a specialist, and the referral requires a visit, and the visit requires an appointment, and the appointment is 6 weeks away. By the time you see the specialist, 3 months have passed since the pain started. The specialist you are referred to does not accept your plan. The one who does is 40 minutes away by 2 buses. You take the appointment because you do not have a better option. The prescription your doctor recommends costs $340 a month. Your plan covers a generic alternative. The generic alternative works, mostly. Your doctor has told you the brand name works better for your specific presentation. Your plan does not care about your specific presentation. Your plan has a formulary, and the formulary is a list, and your medication is not on it. And the appeals process to get it covered takes 90 days and requires documentation that your doctor's office does not have the administrative capacity to compile quickly because they are managing 2,500 patients. You take the generic. The insurance is real. The coverage is real. The gap between what the insurance provides and what your situation actually requires is also real, and it is wide, and you spend a significant amount of your life navigating it. Level 3. Employer coverage. The standard experience. Your job comes with a benefits package: medical, dental, vision. You pay $180 a month for the employee contribution. Your employer covers the rest. The plan has a $1,500 deductible and a $5,000 out-of-pocket maximum. This is what most people mean when they say they have insurance. You have a primary care physician you have seen twice. You have a network, a list of doctors and facilities that your plan covers at the standard rate. When you go outside the network, the math changes in ways that are explained in the 47-page benefits document you received during onboarding and have not read. You need an MRI. Your doctor orders it. The imaging center your doctor's office recommends is out of network by 3 miles. You do not know this until the bill arrives. The bill is $1,100 after insurance. You call the insurance company. You are on hold for 22 minutes. The representative explains that the imaging center is not in your network and that the claim was processed at the out-of-network rate. You ask why no one told you. The representative explains that it is your responsibility to verify network status before receiving care. You pay the $1,100 because the alternative is worse. This is the central experience of mid-level insurance. Not denial, not catastrophe. Friction. Constant, low-grade friction between what you need and what the system is structured to provide. Prior authorizations. Step therapy requirements that insist you try a cheaper medication before the one your doctor prescribed. Explanation of benefits documents that explain nothing and benefit no one. The coverage works. It works the way a door works when someone has installed it slightly crooked. It opens. The opening requires more effort than it should every single time. Level 4. Better plan, same employer, different tier. You have been promoted. The new role comes with access to the executive benefits tier. The monthly premium is $240, slightly higher, but the deductible drops to $500 and the network is broader. The PPO instead of the HMO, which means you do not need a referral to see a specialist. You call and you go. The friction decreases noticeably. You need a cardiologist. You call directly. The appointment is in 10 days. The cardiologist is in network. The imaging they order is done at a facility attached to their office. Everything is captured inside the same system. No surprise bills, no out-of-network processing. The claim moves through cleanly, and the explanation of benefits, when it arrives, matches what you expected. This is not luxury. This is how the system is supposed to work. The reason it feels better is because the tier below it worked badly enough that normal starts to feel exceptional. Your prescription coverage has improved. The formulary is broader. The medication your doctor recommended at level 2 is covered here at a $45 copay. You have been taking the generic for 2 years. You switch. The difference is noticeable within a month. You are a standard customer to your insurer. But the product you purchased is better, and better products inside the same system produce meaningfully different outcomes. Not because anyone is paying special attention to you, because the plan itself has fewer structural barriers built into it. Level 5. High deductible plan with an HSA and real assets behind it. Your income is $280,000. You have chosen a high deductible health plan deliberately, not because you had to, because the math works in your favor. Your deductible is $3,000, but you have funded your health savings account to the maximum contribution, $4,150 for an individual, invested in index funds inside the account, growing tax-free. If something happens, you can cover it. The risk is real, but it is a risk you have priced correctly. And the premium savings compared to a lower deductible plan are going directly into the HSA, where they are compounding. This is the moment insurance stops being a safety net and starts being a financial instrument. You schedule care proactively because you can afford to. Annual blood work, specialist visits for things that have been manageable but worth monitoring, a dermatology appointment you have been putting off for 2 years. You go because the barrier is not financial anxiety anymore. The barrier barely exists. When you receive a bill, you negotiate, not aggressively but knowledgeably. You know what the insurance company's contracted rate is because you have looked it up. You know that providers will often accept that rate from self-pay patients, and you have asked for it and received it more than once. The healthcare system has not changed. Your position inside it has. You are consuming the same services as the people at level 3. You are navigating them with information, liquidity, and time, and those 3 things change everything about the experience. Level 6. Concierge medicine enters the picture. Your net worth is above $2 million. You have standard insurance for catastrophic coverage, major surgery, hospitalization, the events where the bills reach 6 figures. But for primary care, you have made a different arrangement. You pay $3,000 a year directly to a physician who has capped their practice at 300 patients. The national average panel size is 2,500. Your doctor has 300. When you call, someone answers. When you need an appointment, you are seen that day or the next. When you have a question at 9 p.m., there is a number you can text. Your physician knows your history because they have time to know it. They have reviewed your blood work trends over 4 years and have noticed something in the pattern that a doctor seeing you for the first time would not have the context to catch. They have coordinated with your cardiologist and your orthopedist so that the left hand knows what the right hand is doing, which sounds like a minimum requirement of medical care and is, in practice, far rarer than it should be. The insurance company still exists in your life, but at a distance. They handle the large events. The routine management of your health has been removed from their oversight entirely and placed in the hands of someone whose financial incentive is to keep you healthy rather than to process your claims efficiently. This is the first level where the insurance company is not the primary relationship. They are the backstop. Someone else is running point. Level 7. The policy is built around you. Above $10 million, standard insurance products begin to feel like they were designed for someone else. Because they were. You work with a private insurance broker, not a website, not a call center, a person, someone who manages a small number of high net worth clients and whose job is to construct coverage that fits your actual situation rather than fit your situation into a product that already exists. Your life insurance policy is not term. It is a structured instrument that your estate attorney and your financial advisor both have opinions about. Because at your asset level, life insurance is not about income replacement. It is about estate liquidity, trust funding, and tax strategy. The policy is reviewed annually alongside your estate plan. Your health coverage includes medical evacuation from anywhere in the world. It includes access to a medical concierge service that coordinates care across providers and geographies, that can arrange a specialist appointment in another city within 48 hours, that has relationships with the top 5 hospitals in the country and can facilitate admission when admission would otherwise require months of waiting. Your property coverage is underwritten by a specialty insurer that actually sends an appraiser to your home before writing the policy. The appraiser catalogs your art, your jewelry, your wine cellar, and your electronics. The policy reflects what you actually own, not a generic estimate of what someone at your income level probably owns. The difference between this and level 3 is not better customer service. It is a fundamentally different product, written differently, priced differently, and constructed around the assumption that your situation is specific and your coverage should be too. Level 8. The insurer wants your business. Above $50 million, the relationship inverts. You are not seeking coverage. Coverage is being offered to you. Private insurers, specialty firms, Lloyd's syndicates, family office insurance advisors. These are not companies you find. They are introduced through your advisors, through your private bank, through the network of professionals who manage wealth at this level. Your property portfolio is insured under a master policy that a dedicated risk manager reviews quarterly. When you acquire a new asset, the risk manager is notified before the acquisition closes because coverage needs to be in place at the moment of transfer, not arranged afterward. Your personal liability coverage runs to $50 million or more. Not because your risk of liability is higher than anyone else's, because the cost of a judgment against you and the attractiveness of you as a target for litigation scales with your net worth. The insurance reflects that reality. When a claim arises, it does not go to a call center. It goes to a named claims specialist who manages major accounts. The specialist contacts you. The process begins immediately. The documentation is handled by your team. Your role is to answer a few questions and let the professionals process the outcome. You have not thought about whether you have insurance in years. Of course you have insurance. The question at this level is not whether you are covered. The question is whether your coverage has kept pace with the growth of what you are protecting. That is a question your advisors answer without being asked, because keeping pace with your assets is their job. Level 9. You are not buying insurance. You are the risk. At the apex of private wealth, the concept of insurance changes shape entirely. You do not purchase coverage from an insurer. In some cases, you are the insurer. Ultra-high net worth individuals and family offices self-insure against risks that would be catastrophic for anyone below them. A $200 million real estate portfolio does not need a policy for a $400,000 claim the way a homeowner needs one. The math of self-insurance works when the asset base is large enough to absorb the loss without structural damage. The risks you actually insure against are existential, catastrophic liability, reputational events with financial consequence, political risk across international jurisdictions where your assets are deployed. kidnap and ransom coverage for family members, cyber risk on a scale that includes your family office, your operating businesses, and your personal digital infrastructure. These policies are not purchased from a website. They are negotiated, bespoke, written by underwriters who specialize in risks that most insurance actuaries have never been asked to price. The premium is a negotiated number. The coverage is a negotiated document. The relationship between you and the insurer is not a consumer relationship. It is a commercial partnership between two entities, both large enough to understand what they are agreeing to. Somewhere in an emergency room, a woman is signing paperwork that will add $2,800 to a debt she cannot pay, for a visit she could not avoid, because the insurance she could not afford would have cost her more than the bill. The system that priced her out and the system that sends an appraiser to catalog your wine cellar are the same system. They have always been the same system. The difference was never the insurance. It was what you had before you needed it.